All right, let's dive right into this explainer. We're going to break down the structural pressures that are fundamentally shaping our global economy in 2026. We are zooming all the way out from the daily realities of your own wallet to the entire world map, giving you a clear, fact-based look at the interconnected financial system that drives the goods, services, and capital crossing borders every single day. Here is our roadmap for today. First, we'll cover the 2026 economic reality, then prices, jobs, and your wallet. Third is the global energy engine, followed by trade, rates, and markets. And we'll wrap up with a fragmented global horizon. Starting off with Section 1, the 2026 economic reality. So right off the bat, our source material makes this absolutely vital distinction. The world economy is not in crisis, but it is facing several structural pressures. This means we are looking at an era of adjustment and uncertainty, right? We aren't facing a sudden global collapse or falling off a massive recessionary cliff like we did back in 2008. Instead, we're navigating a very specific set of structural pressures that are completely reshaping growth, inflation, and employment worldwide. It's a structural shift, not a systemic failure. The gears are definitely still turning, but the machine itself is basically being reconfigured in real time. Which brings us to Section 2, prices, jobs, and your wallet. Let's think back to the timeline for a second. We all remember the extreme inflation peaks of 2022 and 2023. Those were the years where it literally felt like the price of absolutely everything was just surging overnight, causing a real sense of panic. Well, fast forward to 2026, and the data actually shows those extreme, alarming inflation rates have eased. On a macro level, the economy has begun to stabilize. But even as those rates have cooled off, a major, very palpable frustration is still lingering for pretty much everyone trying to balance a budget. And that leads to the big question you're probably asking yourself right now. If the extreme inflation has peaked and the overall economy is supposedly stabilizing, why do things still feel so incredibly expensive? Why isn't that macro-level relief actually hitting your wallet at the checkout counter? Well, the core friction we're dealing with here is something called sticky inflation. Basically, these are prices that do not fall quickly, even when broader economic conditions stabilize. It's kind of like an economic ratchet. That initial surge pushes prices up, but when the pressure stops, the new high baseline just stays firmly in place. The prices are literally stuck at this elevated level. So this creates a massive disconnect for consumers, because even as the financial headlines loudly proclaim that inflation is cooling down, the absolute cost of living hasn't dropped. It's just growing at a slower pace. You see this friction most clearly in the absolute essentials you rely on daily. Look at the sectors hit hardest by this sticky inflation: food supply chains, housing and rent markets, and healthcare and education services. We aren't talking about luxury goods here. This is the food on your kitchen table, your rent, your unavoidable medical bills. Because these are life necessities, consumer demand is going to remain completely constant regardless of price. You can't just stop buying groceries, right? And that constant demand makes it incredibly difficult for those prices to naturally drop back down. That is exactly why things still feel so incredibly tight month after month. But it's not just what you pay, it's also how you earn. This economic friction is creating a highly uneven, super unpredictable labor market. On one side of the economy, we see expanding sectors like green energy and specialized tech that are just desperate for talent. But simultaneously, we're witnessing massive shifting trends, completely disrupting traditional career paths. We've got automation rapidly replacing routine tasks, a structural explosion in gig and freelance work over stable permanent roles, and at the same time, much slower hiring in the broader tech industry. This creates a deeply divided landscape, and it's especially tough for young workers caught in the middle of these shifting sands. Okay, moving right along to Section 3, the global energy engine. This perfectly illustrates just how sensitive and interconnected our economy really is. It's a total chain reaction. Step 1, geopolitical tensions and the complex transition toward renewable energy disrupt the baseline supply. Step 2, because energy is so foundational to absolutely everything we do, these supply disruptions cause oil and gas prices to continuously fluctuate. And Step 3, that fluctuation trickles directly down to you. Even a tiny change in energy prices significantly increases the cost of transporting goods, manufacturing products, and growing food. So when you're frustrated by those sticky food prices at the grocery store, you're actually looking at the downstream effects of global energy volatility playing out right there in the produce aisle. Let's zoom out a little further for Section 4, trade, rates, and markets.
To fight off that sticky inflation we just talked about, central banks in major economies have had to maintain relatively high interest rates. It's basically their primary tool to cool demand. But man, this medicine comes with some severe side effects. The impacts are painfully clear across the board. Business expansion loans become incredibly expensive, meaning companies grow slower and hire fewer people. For everyday individuals, it means much higher monthly home mortgages, pushing homeownership further away for a lot of people, alongside costlier consumer credit cards and personal loans. Essentially, to cool off rising prices, central banks intentionally slow down overall economic growth, which directly tightens your financial flexibility.
Meanwhile, corporations are taking their own defensive measures through a strategy called nearshoring. This is where companies shift their supply chains closer to home to improve national resilience and economic security. Following all the global disruptions we've seen recently, companies desperately want their manufacturing to be closer and more secure. But here's the critical trade-off. While nearshoring definitely improves resilience against sudden supply chain breakdowns, it actively moves production away from the absolute cheapest global options. Security and peace of mind come at a premium, and you guessed it, that premium is ultimately passed straight onto the consumer.
This structurally shifts the entire global market into two very distinct lanes. On one side, we have strategic sectors experiencing fierce, intense competition. Think semiconductors, AI hardware, and electric vehicles. We're talking about entire countries and massive corporations fighting for technological supremacy. Conversely, due to persistent market volatility and uncertain growth paths, cautious investors are retreating. They're actively seeking out safe assets, heavily preferring reliable havens like government bonds and gold. It creates this fascinating market defined by extreme aggressive innovation on one hand and deep protective caution on the other.
Finally, Section 5, a fragmented global horizon. Zooming all the way out to a satellite view, global economic stability today is undeniably influenced by international politics. Strategic competition and ongoing conflicts between major powers are fundamentally restructuring the global economy. These geopolitical shifts are directly disrupting long-established global trade routes, they're changing international technology access, and they are dramatically altering where foreign investment flows. We are moving decisively away from the seamlessly connected, globalized world of the early 2000s toward one that is heavily characterized by protective tariffs, trade restrictions, and fiercely competing economic blocs. Distilling all of this source material into one overarching takeaway brings us to this. The 2026 economy is stable, but it is slower, more expensive, and more divided than before. Our global economy is not collapsing into a depression, but it has absolutely transformed. Persistent inflation, high interest rates, geopolitical tensions, and sweeping technological shifts have permanently reshaped how countries trade and how they grow. This isn't just a temporary phase we're waiting out. It is a new, undeniable baseline for the future. So as we wrap up this explainer, I want to leave you with this crucial question to really chew on. As the world's horizon fragments and we settle into this more expansive, slower growth era, how will you navigate and adapt to this newly divided economic reality? What steps will you take to adjust your career, your investments, and your everyday budget? Thanks so much for joining me for this breakdown.